2. Key events of the 2008 financial crisis. The crisis began to unfold in 2007 and reached its peak in 2008. The following key events marked the most critical points of the crisis. A. Early signs of trouble 2007. By 2007, housing prices began to decline, and the housing bubble started to burst. As more homeowners defaulted on their mortgages, the value of MBS and CDOs plummeted. Bear Stearns, a major investment bank, was one of the first institutions to show signs of severe distress due to its exposure to these securities. In June 2007, two of its hedge funds collapsed, signaling the beginning of the credit crisis. B. Bear Stearns collapse March 2008. In March 2008, Bear Stearns teetered on the edge of collapse due to its heavy investments in mortgage-backed securities. Fearing a systemic financial meltdown, the U.S. Federal Reserve facilitated a sale of Bear Stearns to Morgan Chase at a fire sale price, backstopped by government guarantees. C. Lehman Brothers bankruptcy September 2008. Lehman Brothers, another major investment bank, was heavily invested in toxic mortgage-backed securities, and like Bear Stearns, the U.S. government decided not to intervene to save Lehman, allowing it to file for bankruptcy on September 15, 2008. Lehman's bankruptcy, the largest in U.S. history, caused a global panic and triggered a massive sell-off in financial markets. D. IG bailout September 2008. Following Lehman's collapse, IG, one of the world's largest insurance companies, faced bankruptcy due to its exposure to credit default swap CDS tied to mortgage-backed securities. The U.S. government stepped in to bail out AIG with an $85 billion loan, fearing that its collapse would trigger a global financial catastrophe. E. Global financial meltdown late 2008. Lehman's bankruptcy caused a global liquidity freeze. Banks stopped lending to each other out of fear that they, too, would collapse under bad assets. Stock markets plummeted worldwide, and major financial institutions across Europe and the U.S. either failed or required government bailouts to survive. F. Top and government intervention. In response to the financial meltdown, the U.S. government passed the Emergency Economic Stabilization Act in October 2008, which authorized the Troubled Asset Relief Program TARP. TARP allocated $700 billion to purchase toxic assets from banks and inject capital into struggling institutions. Major U.S. banks, including Citigroup and Bank of America, received large infusions of capital. G. Global economic recession. The financial crisis soon led to a deep global recession. Global trade, industrial production, and employment fell sharply. Governments around the world implemented massive stimulus programs, while central banks slashed interest rates to near zero and injected liquidity into the financial system to stabilize economies.